Welcome back to Good Revenue. I'm your host, Neeta Bidwai. Today, we're going to talk about how to get out of a bad revenue sinkhole, if that is your situation. And I think it's pretty common for a lot of companies today. So we'll just start with a few terms. First of all, I define bad revenue as the deals that look nice in the short run, but they have a long-term or a hidden cost. Some of the common signals that I think a lot of companies are facing today: you're missing targets, revenue growth has slowed, competitors have gained market share, and it's very evident to your customer base, excessive churn, excessive revenue concentration across one or a few large customers, and CAC payback is more than 36 months and might be as high as 48 or even 60 months, according to some of the data that I've seen. The flip side of bad revenue, and the goal that I am hoping we are all working towards, I know it's a real North Star for me, is good revenue. Good revenue benefits the business short and long term. In a good revenue model, and if you have good revenue customers, what you're seeing are customers that get your value. These are the customers that don't churn, they refer you business, they are profitable. When you take a calculated risk to do something for these customers, maybe to add a product or to build a feature or something else, there's a good bet that it's going to help you stay on strategy, and it'll be a reward to your business and to the customer. It's a win. This revenue and these customers make you better, and they really appreciate the value that you deliver to them. So, how do you actually break bad revenue? You break it by identifying what's actually going on, which might sound simplistic, but it often isn't, and understanding how you got off track in the first place. The way to do this is a pretty straightforward framework. You talk to customers or bring in an outside advisor to help you with it if this is difficult to do internally. Your goal in this process is really strategic, meaning you are looking to identify the challenge that your business is facing, and you are coming up with trade-offs and actions that are going to help you do something differently to meet that challenge. If you're not going to do anything differently, I think it's unlikely that you'll have a different result than what you're experiencing today. In this framework, and I won't go too far into it because we have other episodes where we talk about pricing and segmentation, and we'll link to them in the show notes so that if you want to walk through our process, you can do that. But the process here is very similar. We want to go through deep customer insights and through a segmentation that is tied back to willingness to pay. And pricing is one of the things that we can really do in the short term. I'm thinking as little as a quarter to dramatically change your business. Everything from the actual price point, packaging, key messages, your go-to-market, your product lineup, and your roadmap, if that is something that you have in your business. Longer term, I highly recommend that you also look at what are some of the underlying issues that might be holding your product back and your go-to-market. And a lot of times, I think companies do obviously know this because most companies are full of really smart people who want to build great firms and great products, and there might be institutional barriers or history or some other challenge that's holding you back. So it's not that the problem is necessarily unknown, but it's not insignificant to really think about it across functions and across departments and teams. I think that is a really difficult challenge for a lot of organizations. And I wish I could say that I think it's just that larger companies have this problem, but I think it happens across small firms and larger firms. But anyway, back to the question at hand here. Pricing is all about validating what customers value. And I talk about it all the time, but I think it's worth referencing here. Features, attributes, capabilities, these are the things that we build, deliver, or offer as a firm. Benefits, that is the anticipated utility of whatever it is that we've built or deliver or offer. Value is what is the customer willing to pay for our widget, our service, whatever it is that we're bringing into the world. And it's very important to get that information directly from the customer, because I will guarantee you that if you have not talked to your customers with a really deep eye towards understanding their willingness to pay, there's going to be a gap between what you think the customer values and what they actually care the most about. So this, as I said, is something that you can do within 90 days. And we will link to our pricing framework and some of the other processes if you want to dive more deeply into this. Some of the questions that I think you should consider at this point in the process too. Do you have excessive revenue concentration across a few customers? If so, you need to quantify this because it is something that might actually turn into a secret weapon that can help you find a new segment or a segment of similars that can help you get out of this hole. So an example might be that you have built a product for a very large bank, let's say, and they have very specialized needs and requirements. And it made a lot of sense in the early days because they were a big customer for you and they still are. The problem is that many of the things that they've asked for can't be easily offered to other customers. What you'd be trying to do in a segmentation and in customer interviews with a broader set of potential target customers is you're trying to figure out if pieces of your offering or of the product might be acceptable to others. For example, if this was a software product, what we might be trying to do is repackage elements of that offering and try to build something that works for another segment. So it might not work for another large bank, but it may be that there are other players, maybe not even in the same industry as your existing customer, who could really benefit from what you've done. And it's important to keep an open mind in the process because this can surprise you. And it's worth at least trying because for you, it's a sunk cost. You've already built something. And what we're trying to do is see if we can pattern match and find other potential customers who could benefit from it. It's also important to keep in mind that if you're in an excessive revenue concentration system, I think it's unlikely that another segment or potential customers are going to pay the same amount of money as what your current customers are. But if you have enough time and determination, I think you can still potentially build really significant and helpful packages with another viable customer that can help you ease that concentration. Second, are you able to expand margins with your current pricing and offerings? Third, is your CAC payback more than 36 months? As I mentioned above, that's a huge issue. Is LTV a realistic denominator for you? And LTV is lifetime value. Many businesses have been using the CAC to LTV ratio as a target, as a North Star over the last decade. And as a result of this, I think there are some really unsustainable assumptions that have been built into this model. Because in the decade of easy capital, the assumption has always been that LTV is going to be somebody else's problem, likely after you exit. There's some really great analysis that I came across recently from a firm called Bench Sites, and I will link to some of the data that they've shared because I think it's worth taking a look at. And even if you don't want to make dramatic changes to LTV because maybe you have investors or maybe there's some other considerations, I think it's really important to have an honest conversation with your team about what net retention looks like. Because if you are experiencing a lot of churn, that ratio is going to look pretty ugly and is pretty unrealistic. And so I think it might be a good forcing function for tough conversations if you haven't been having those already. Another question I think that's really important to keep in mind is, have you done a segmentation of your customers in the last 12 months? Because if you haven't, I guarantee you the world has changed and you probably know this already. That's likely why you're listening. So take the plunge, do this pricing segmentation, and I guarantee you're going to be really happy that you made this investment. Some of the outputs of this process are going to include the ability to help you align your value and pricing metrics. Again, I would anticipate some of this will be different than what you do today in a robust segmentation. You'll be able to create bundles for better cross-sell and upsell opportunities. You'll be able to actually define what those upsell and cross-sell paths are and look like. And this is, again, a really interesting one because oftentimes when the world has changed, some of these pathways are going to change over time too. And until we really do a segmentation and look at this market more broad-based or holistically, I think sometimes it's easy to get tied up in the day and to miss some of those bigger picture opportunities. You can develop new pricing models that are going to actually support your go-forward strategy, not just the pricing models that you were using in the past. And finally, if you've gone through an acquisition or you're in an integration phase, anything like that recently, there are huge opportunities and reasons to do a segmentation as soon as you possibly can, because a lot of things have changed. You very likely have common customers across the parent company and the acquiree. There may be multiple companies that you've acquired over time. This is a great way and a great tool to actually reset what your products and offerings look like from the customer's perspective. And if you don't do a robust segmentation, I think it's really hard to have this perspective just internally. Another thing I want to talk about is the raising prices, which is obviously one of the simple things that everyone tells you to do. And it's one of the things that kind of drives me insane because I often hear people advise just raise prices. Obviously, if you have been undercharging for a really long period of time across all of your offerings and all of your customer segments, then yes, sure, raise your prices. But I find that hard to believe in a lot of cases. What I think tends to happen is that there are some customers that you are likely undercharging, and there may be some other customers that you're overcharging. And so the reality is that if you raise prices on everyone without any thought to who's getting what, you're going to see some folks that leave you. Now, you might think that you have a monopoly or an oligopoly, and maybe this doesn't matter. And in that case, yeah, this advice probably doesn't apply to you, but I do think that the FTC is on the case these days. So there may be different issues that you're considering. Instead, I think a really simple framework to keep in mind that I like is to basically just do a simple 2x2 model of great value for you on the X axis and great value for your customers on the Y axis. And think about it like this. If there is great value for both you and your customer, so it's the top right quadrant, you can raise prices as you increase value. And when people are telling you to increase prices and deliver more value, this is who we're talking about. So if you've got a robust segment, a lot of customers here who are happy, they love it, keep on keeping on, and raise prices as you go. That makes a lot of sense. When you go to the top left quadrant, this is the value to you is low, but customers are getting a lot of value from you. Then yes, this is another category in which you should raise prices, and these customers are going to stay. Why? Because they get more value than they're actually paying you for. And again, you would know this if you've done a segmentation and you've done some modeling. You will have a sense of who this is and how many customers this might be. Bottom right quadrant, this is great value for you and low value for customers. Now, this is a tricky quadrant, and I think this is a quadrant where a lot of companies have many customers in here, in this segment. And I think that they tend to overestimate how many customers are actually in this quadrant. So it's another reason why I would really recommend doing a good segmentation so that you have a clear sense of, is this 70% of my customer base or is this 20% of my customer base, whatever the numbers may be? Because in this quadrant, great value for you, low value for the customer. If you raise prices, these folks are going to churn. So you've got to give them more, specifically more of what they actually want, if you want them to stay and pay you more. And again, there is work to be done because very likely your offering doesn't cover this, or maybe it is that your offering is already, it is there, but it's too expensive or it's too slow. There might be something else going on, but I think there's some great inquiry for you in this quadrant. In the bottom left, this is low value to you and low value to your customer. Yeah, sure. Raise prices because some folks are going to churn out. And maybe there's some folks that forgot they were paying you and they get interested in this again, or they have some other reason that they're going to stay and they're going to pay you more. And you don't need to worry too much about them. Again, totally fine. That makes a lot of sense. You want to know what the numbers are across these four quadrants. Every time I get to do this kind of work, I just want to ask more questions. I hope that you have a similar experience when you get into the weeds. The other thing that I just want to suggest too is that there's always a timing question around when to do pricing work. And particularly if revenue is not in a good spot and you are in this bad revenue sinkhole, I think you should get on the case as soon as you possibly can. And it might feel tricky because it might be a time when you've gone through budget cuts or layoffs, but at the same time, choosing to cut 10% or 20% or whatever of every team and headcounts across the board is just not a great strategy. And I'm really simplifying it here. I don't mean to imply that this is a simplistic process for most, but I do think that sometimes companies fall into a trap of wanting it actually to be more fair and more equitable, maybe across teams, instead of doing this critical work of a pricing segmentation, which gives you more robust analysis of what your customers and what the market really care about. And then when you have that information, I think you're actually better able to understand where you would make cuts and also where you should make investments. Don't limit yourself to just analyzing contracts or worse, just looking at what the competition has done. I see a lot of companies doing this. And one of the ways you can tell if that's happening in your industry or in your sector is that if somebody raises their price to $25 or $50,000, whatever the price point may be, and you see the rest of the competition going along with that as lemmings, I think that would tell me there's a huge opportunity to do a really strong pricing segmentation. And what you're trying to do is to figure out how to differentiate yourself and your offering so that you can actually take more market share and win. And if the market is such that no company, no customer can really tell what the difference is between you and 100 other companies, you're all missing out. And so I hope that you're the firm that chooses to do something differently. Bringing that back to contracts in particular, because this comes up all the time. I think your contracts are historic information. They're a really important input into your decision making, but they're also a moment in time. And you have to keep in mind that moment in time may have been when you were under pressure. You may have given discounts. Your product may have been not great. Maybe something was going really well for competitors at that moment. These are just snapshots of time. So they should be inputs. They shouldn't be the determinant in terms of what you want to do with pricing in the future. And again, that's what a segmentation can really help you with. It's also important to keep in mind that your old contracts very likely include discounts that your finance team authorized in a hard quarter or maybe a series of hard quarters. And so again, if you're trying to baseline future pricing off of that, you're not really getting as accurate a picture as you might think. I hope that this information has been helpful to you. We wanted to just do a quick rundown of some ideas to break through bad revenue. Thanks for joining us here at Good Revenue. If you liked what you heard, please leave us a review, follow the show, or share it with a friend. We're a news show, so it really helps other listeners find us. And if you have feedback, comments, or suggestions for episodes or guests, please reach out to us. You can find our information in the show notes.